with new questions about how far this rally can really go. Let's ask Rick Rieder. He is BlackRock's CIO of Global Fixed Income. It's head of its global allocation team as well. And as I said, he is with me here at Post 9. It's good to have you back.
Thanks for having me.
I tell you, you sent me an email earlier. I had to do a double take. You said this is the best investment environment ever.
I think that.
You mean that?
I do, because, and by the way, it doesn't mean necessarily everything's going up, but there's a couple of things at play that are pretty extraordinary. First of all, as you take the equity side, first of all, the technicals and equities are crazy. I know we've talked about it before. Amount of cash on the sideline, the amount of buybacks relative to the IPO calendar, i.e. the demand versus supply, is pretty extraordinary. And these companies, you know, we've talked about on the show, the multiple is not that attractive. These companies are throwing off the earnings growth. So I looked at 2024. If you strip out Tesla for obvious reasons, Mag 7 year-on-year growth is like 54%. You get through multiple pretty quickly when you're growing that fast. Then you take the other side of it is you've got in income, in fixed income, you're getting yield levels. Listen, I think the Fed can cut rates, but until then, you got yield levels. You can create portfolio 6.5%, 7% yield. That's pretty good. I would throw one last thing. Today, volatility, you don't have to necessarily, one of the things I always think about, what's your exit strategy? What's your escape hatch if you get something surprising? The volatility, the equity market, you know, we did a trade today, equity vol, I think it was 10 vol, 9.5, 10 vol to own, like crazy low volatility to own equities. So you don't actually have to take the downside risk. So that's a pretty good environment.
And the Fed's going to cut in September?
Listen, I think they can cut. I think it's almost a given that they cut. And, you know, particularly if you got a payroll report that shows what has heretofore happened, you're seeing some sogginess around job hires, around job openings, that I think the Fed's got. You've got more slack coming into the labor market, so I think they can move. Listen, I still think the funds rate, you can get it down faster and more aggressively than where they are today. You're talking about, you know, the inflation report today. Mm-hmm. You're still talking about there's a little bit of elevation from tariffs, which I think you have to be respectful of, and I think the Fed's been respectful of that. But you're still running under 3% core CPI, and things like shelter, you're starting to see some improvement in. I think they've got room. You talk about 5-year inflation break-evens at 2.5%. I think you got room to get that funds rate down 100 basis points.
Why aren't they all talking as if they have room? And not everybody agrees with your assessment. They're worried about sticky inflation. They look at the CPI and they say, well, yeah, it beat expectations, but it still shows that it's still a bit of a problem and it's above our target.
So, Scott, I think there's something that's really important. How the interest rate tool affects inflation. You think about the Fed raised rates 500 basis points. The impact on the economy, inflation, I would argue, not terribly significant. The interest rate tool doesn't do a lot today. You think about how companies finance CapEx, big cap. You're not borrowing. You think about the banks are asset liability. The interest rate tool is not that important, except for a couple of big factors. What it does to housing, and you look at mortgage applications, building permits, housing starts, new home sales.
Frozen.
Stuck. The mortgage rate has to come down. You drop the funds rate, you know, there's some yield curve steepening that probably happens. And then the other side of it is, the low income people who are the borrowers, you're actually, you know, they are getting hurt by this. High savings, older people are actually benefiting from the high rates. And the last thing that I will say, I don't think the funds rate has to be at 4 3/8. The cost to the government, we have too much debt in this country. To charge an extra 100 basis points, when I think the transmission of how it impacts inflation that I think is dull to start with, is it worth it? It's a pretty high price to pay.
If the White House is listening to what you're saying right now, they're all standing up yelling, yes, yes, this is the story we've been trying to tell.
Yeah, I mean, I'll say a couple of things. One, I think you have room, and I think you have room to bring that rate down. I also think there's something spectacular happening around productivity. Much of what's happening on the backside of this technology investment, not just the traditional hyperscaler dynamics, but you think about how big companies are using data. You think about space as a new technology. Like, all of these are geared towards higher productivity, operating at a lower cost basis. That's where we're going. I sent you over this chart. I don't know if you saw that chart that shows, other than a pandemic, a once in 100-year dynamic, inflation, volatility of inflation, for the last 25 years is incredibly low. We don't run an economy that's manufacturing, commodity-oriented. It's not cyclical. Mm-hmm. Volatility of inflation is incredibly low, and we're seeing enhanced productivity. But I'm not that worried if the Fed drops the rate that all of a sudden we're going to see inflation pick up.
I mean, you've been bullish. You've urged people to continue to look at stocks. You've made really good calls on this show. Nothing scares you? Like,
listen, would I like to
valuation? No. I mean, you defend growth. You're not worried about tariffs.
So I would say, I'll tell you what I'm most worried about: complacency. Like so think about the vol we're buying today. Like, people are selling us insurance, and people, think about the way markets work, the way insurance works. Nobody buys insurance when you're far from the hurricane. They buy it right after when the price is too high. Today, the price of insurance is incredibly cheap. We can hedge our portfolio. Complacency is high. You see it in some of the credit markets. That being said, I think, I'm sanguine on the economy. I think we're moving generally in the right direction. Listen, one of the reasons why there's a great investment environment, there's a lot of news flow that allows you to take advantage of opportunities. Markets, particularly in August, they tend to overreact to things. So your ability to actually take advantage of that. But complacency to me today, I'd love multiple to be a little bit lower, to be honest. And I know like spreads to be a little bit wider in the credit markets. But you see where the technicals are, where the amount of cash, we were looking at it, amount of money that's gone into money market funds, including last week, is extraordinary. Some of that is going to move into equities and other fixed income and other assets.
We have